Welcome to the My Money Circle podcast. I'm Rebecca Marfe.
I'm Anthony Matthews.
Let's get into today's podcast.
Well, good morning and welcome to our next podcast, Rebecca.
Thank you. It's good to be here.
I'm going to be the host with the most for this one. Normally, you've got the captain's chair, but I'll slide into it for a one-off today before we go back to normal.
Only fair
service.
to share the joy around.
And the reason we're doing that is because this episode is on risk. And risk means different things to different people. I suppose in my long and semi-distinguished career in banking and financial markets, risk was always, and some people are mean about it. They say, well, banks and investment banks take casino risk. They're trading bonds and shares and so on. It's like going to the casino. Now, obviously, I think that's a very terrible, characterization of what goes on with bright people in a room, hedging risk or taking risk, smart risk for banks and creating value for society. But then there's risk I know from your career, which is insurance and so on, which is, a very different way to think about risk. So today we're going to cover very briefly and without getting all kind of, university economics about it or scary about it, what risk is, and there's good risks. And then what risks we might call bad risks or, complex risks that, maybe people are taking without even being aware of it. Yeah. Then we're going to talk about how we hedge risk or deal with risk to the extent we can, which is hard in life. We all know there's heaps of risks, whether it's ourselves, our economy or our business. Everything's risky if you think about it, and you'd be overwhelmed if you think about it too much. But there's things you can do. Yeah. And then finally, we'll just talk a little bit about the academic theory around it. There's been Nobel Prizes handed out about this. This is how hard this all is. So.
Oh, I can't wait to hear about that. I'll let you cover that.
So we're good to kick off?
Yeah, let's go.
So the first thing I thought, just to everybody out there to relax and realise, it's not just feeling unprepared or unskilled about taking risk, that very bright people can also muck it up. And do you know one of the brightest people ever to live was Sir Isaac Newton.
Yes. Oh.
And guess what Sir Isaac Newton did? He got caught up in a bubble called the South Sea bubble. And we can look back at the charts if you have time. We won't go through all of them, but we all know about the tulip bubble, the South Sea bubble. We could argue, well, definitely the .com was a bubble. Yeah. Even Mr. Alan Greenspan, God bless him, passed away recently, but he called it out early. And the problem for him and in the market, it kept going. Yes. So we all know a bubble, but it can keep going. Yes. So Isaac Newton decided to double down. He was quite a wealthy guy in the time. And then the South Sea shares started rising and rising and rising. And he goes, I've made 100%, made double his money. And he decided, you know what? I'm cashing out. I'm out. And who hasn't done that? And we're going to get back to the theory of this later. Guess what he did then? Couldn't stand for the next 6 months. It kept going higher and higher and higher. So what did he do? He said, I'm back in. Yeah. And then it plunged. Yeah. As it was plunging, guess what Sir Isaac Newton did? Bought some more. Then he bought some more and he goes, I'm buying the dip.
Well, it's the only way to, it's the only play left at that point.
So I just thought that was a great way of getting everybody to go, look, even arguably the brightest person ever to have lived mucked up investing and mucked up risk management. So there we go.
It's a good intro into managing risk, right? You can think about everything. You can know all the theory. You can have thought through the upside, the downside, every which way. And at the end of the day, sometimes there's a whole range of things that are out of your control. Right. But it doesn't mean that you shouldn't prepare or plan or think about it.
Excellent. So that's a great segue into good risk.
Yeah.
And another little factoid, the word risk comes from the Italian. I don't even want to have a go at pronouncing it.
I think you do.
Risicare.
See, you've been practicing.
I had a stab at it, and if anyone out there can pronounce it properly.
You've said that 100 times this morning.
Let me know. Anyway, fascinating. It means to dare.
Right.
It doesn't mean be careful, and it means to dare. Now, whether or not you pull the trigger on daring, do I jump off this cliff or do I take but dare to think about it might even be a definition of risk. So on that, let's talk about, well, what is risk? And maybe, as I said, there's risk that banks hedge. There's risk in your mortgage. that interest rates go higher, and a lot of people are living with that at the moment.
Yep.
But a mortgage is good risk. You've got a house. There's an asset behind it. And we'll get to gambling later on, but there's an asset there. So you've said, I'm buying this asset and I'll take the risk. So that's a great example of a good risk. When it comes to your super or in your investing, and again, we've got a disclaimer at the end of this, Rebecca, that we're giving general advice today. We're not here to tell you, exactly what to do, given your personal circumstances may be different to everybody else's.
Yep.
But look, the very, very simplistic way of looking at risk for super and your longer term investments is the volatility of your returns.
Yeah.
What you need to retire on, you might not achieve. Or when you're about to retire and you've got all your money in the stock market and it goes down 40%, that's not ideal. So that's kind of an investment assessment of risk. And when you go see an advisor, they'll ask you, what's your risk appetite?
Yeah.
So maybe that's kind of your area of expertise, and maybe that's a good place for you to kind of jump in and tell people what that is and then what that means for their investments.
Yeah, well, I think risk, just generally speaking, means something different to everybody, which is why when you do go and see a financial advisor or someone who's giving you investment advice, to your example, it takes you through what's called a risk profile, because the whole point of that exercise is to try and help people who've probably never thought about their own appetite for risk work out where they sit on what we probably very casually call the risk curve. So that just simply means, are you someone who's very conservative when it comes to taking risks with money? Or are you someone who's more adventurous or aggressive or growth orientated when it comes to taking risks with money, or somewhere in the middle, which is what we would call someone who's more balanced in their view of risk, meaning you can see both the reward and the upside and also the downside and the risk attached to decisions about what to do with your money and where to invest it specifically. I think to me, just pulling it back out of investments as well and just thinking about risk generally, risk, as you said earlier, is something that is part of everything that we do. It's part of every day. It's part of all pretty much decisions that we make. There's a risk to the decision. Sometimes the risk is bigger and has a higher cost. Sometimes it's little and it's sort of not worth a lot of attention. The cost of that risk is negligible, so we spend less time on assessing risk as part of that decision. But to me, risk just really means looking at something, a decision to be made, and saying, what is the upside here? And what is the downside? Now, the risk part is really looking and reflecting on what the downside of the decision is. So, and by that I mean, what could I lose? What could happen to me or to my money or to whatever that you're deciding on? And what then would be the result of that? So what would I have to, what would I then suffer ultimately? And would I be able to deal with that?
And how do people, when they're in this meeting, how do they think about it? Like, how would an advisor kind of, because I could see some people coming in going, well, maybe this pot of money I could invest aggressively, but I want to protect all the rest. And so you'd have to step back going, well, you kind of can't have your cake and eat it too. Like, there's an overall risk you want to run. So how should people think about that if they haven't seen a financial advisor and you're saying they're going to ask you what your risk appetite is? How would people kind of work that out?
Well, a risk profile in itself is quite a specific artifact, if you like. So it's a very curated set of questions that's designed to help people not really have to think through how they would work it out, because it is a difficult thing for people to self-assess, really. So a risk profile is curated and is designed to ask people a series of questions that gives them some context and a bit of a framework for thinking about, with specific scenarios, how they would feel in that scenario.
Right.
And
so
that,
you're kind of getting guidance, aren't you?
You're
You're getting a bit of, there's a path set.
yeah, that's
And
absolutely
then
right.
as you choose an off-ramp or an on-ramp along that path, that's going to set how you get your investment
that's
profile
right. And
set.
that is the role of one of the most valuable roles of a financial advisor in that situation. So someone that is there and can provide some context to that, obviously without influencing the decision or the answer, but it just allows someone to understand what's being asked of them properly so that they can answer honestly and appropriately too. I think if you're outside of that setting, if you're trying to examine your risk profile with respect to your finances or your investments, it is a little bit tricky because you do need to sort of sometimes go a few layers deep around what your instinctive response to the question being asked is. Well, one typical question is in a risk profile, we'll sort of ask someone how would they feel about their investments or their portfolio if the balance suffered a 20% loss overnight. Now, a lot of people would think that sounds horrific.
And they'd hide under the table.
And they'd hide under the table and whatnot. But there's a couple of reasons, there's a couple of things that go into the instinctive response. It's like, well, what's the level of education that exists about markets in general? And if you understood a little bit more about things like volatility, for example, would you then have the same answer to that question? The other thing that plays into your feelings about risk with regards to investments comes back to a whole set of beliefs, if you like, or scripts we call it, money scripts around how you think and feel about money. You know, your attitude towards spending and saving, for example, your money personality and around those things. A lot of people who are very good and hard savers tend to have a little bit more difficulty with the concept of losing a 20% of that value overnight. But again, that comes down to just understanding more about yourself. And then also a little bit of perspective too. I think some people, there is something called loss aversion. So what that means is that as human beings, we have an aversion to loss and more so than an appetite for a reward attached to the same decision. So if you are thinking about it through a tunnel vision of only what would happen in that situation where you've lost 20% of your balance, there's a perspective element here in saying, well, again, does it stay down 20%? Well, the answer to that is no. And then also, what's the income situation look like or the growth contribution piece look like? Because if someone can see the bigger picture and not just focus on the downside, you've got to balance the downside with the upside so that you can see the whole picture and work out, okay, there is some significant downside, but there's also a lot of growth and these are the other things that mitigate that risk. So therefore, I'm happy with this decision.
And how does that then play into maybe some of the investments that people might have? So I'm just thinking maybe people are interested in what would be considered a low-risk product, a medium-risk product and a high-risk product. I can obviously think of it in different terms of volatility. To me, like a low-risk product might be somebody just going, look, you're coming up for a bit of a life event. You need some cash or liquidity. So they might put you in, almost like a term deposit would be like an ultimate low-risk product, or bonds, government bonds, for example. A medium-risk product might be a balance fund. So it's got some shares and some bonds, but also a little, a balance between Australian and global exposure. Then a high-risk product might be crypto or some leverage product based on, just having a ETF, for example, of AI stocks or something like that. Is that right? Like if somebody came in, is that the kind of way to think about these products without keeping it in general advice? We're just talking about risk and products. We're just trying to show people how risk changes across those products.
It is, absolutely. I think if you were to open a book on product risk and look at what kinds of products were listed against something generally considered by the industry as low risk, medium risk, high risk, then what you've just described would be what you'd see. That's how they kind of fit into the bucket of product risk.
Right.
But I think then if we're talking about risk more holistically, you then got to consider, okay, well, and we talked about this before, is that there are other types of risks associated with finances and investing, and those are things like underperformance risk. So for people listening, yes, cash and bonds are considered a safer or lower risk, more capital stable product. But if you were to be invested in them your entire life and you're just somebody who's like everybody else, and we're not talking about having $100 million invested in those things and living off the income, because that might be fine. But for everyone who's trying to grow wealth and live their life and, there's a secondary order of risk, which is if you stay in just that, you may underperform and therefore not reach your goals. So we then need to consider other types of risk and introduce them into the equation and get people to think about the big picture, risk picture.
Do you know what the fascinating paradox of finance and money and markets? There's fascinating paradoxes everywhere. Not taking a risk is taking a risk.
Yep. And
it's wonderful, right? So you're like, I think the US stock market's going to crash by 50%, or I think all these changes in the budget, the Australian stock market's going to have trouble, so I'm going to go all into cash. Well, no, that's also taking a risk, even though you think you're de-risking or taking, your money that's exposed to all these potentially, adverse things and just putting it in cash or just sitting in some other safer investment. We've seen over the last year the S&P went, lived up to a lot of people's expectations of really struggling, and then it's had one of its best periods of recovery.
Yeah.
So the problem is when you're younger, you've missed, there's only a certain period all through your life that the market's going to have really good periods of returns. And if you're not in those periods of return, it's really hard to make them up.
Yeah.
So funnily enough, not taking a risk is a risk.
Yeah, and so I think when it comes to the concept of investing and growing wealth, the good part for people about getting their head around risk is that a lot of the risk has already been discovered and written about and planned for when you are talking about growing your wealth.
Yeah.
So we've got certain types of investments. There's only so many places you can put money to grow it. A lot of those products are well written about, well researched, and many of them have, over 100 years almost worth of data.
Yeah.
That's not to say that past performance is an indicator of future performance. So that's another risk to consider, the macroeconomic environment. But it is, there's a lot of research. There's also a lot of formal guidance to help guide the decisions around products and
Super
things.
Fund will do that. An advisor will do that. You can take advantage of all those resources.
And they can also bring into the conversation and help you become aware of those second order risks we talked about, like, underperformance is one. Just understanding market volatility.
Well, really the most important
timing.
one in there too is just time.
Yeah.
I was speaking to somebody just yesterday and they're like, oh, how do I achieve this goal? Well, you probably should have started 30 years earlier.
Yeah.
The old saying in markets is, it's time in market that's going to get you there. You get wealthy slowly. And let your money do the work. So just contribute, to whatever investment plan, or have a plan, as we've talked about on other episodes, and invest slowly and let your money do the work. The thing that people do, and it's another risk, we could be here all day, if we were doing a finance degree or something, there's almost an infinite number of risks. But one of them is is just over trading, overthinking markets, checking things every day. You just got to be able to sleep at night, but having a good plan mitigates a lot of that. You don't want to be like Sir Isaac Newton, I guess.
Yeah. Well, so you've just raised another risk, which is the risk of your own mindset getting in the way.
Yeah.
Or your own behaviour, investment behaviour. So many people don't even consider themselves investors, even when they are invested. I mean, if anyone that has a super fund is an investor.
Yep.
They might not be as actively involved as they might with their investments outside of super, but investment behaviour is a risk if not understood and then managed and, as you say, have a plan. And what I mean by that is just I referenced loss aversion or something before. So just being aware of the psychology of investing and how that impacts you.
Yeah.
Your own attitudes, your own fears, and just being mindful in your approach to the risk that your own behaviour places on investing as well.
Now that is a perfect segue to the next thing we want to talk about, which is bad risk.
Yeah.
Now, we don't want to ruffle any feathers here, but there's investment risk we've talked about, but then there's other risks that we take personally that kind of sit in the middle. They're not an investment. They're more like a gamble. And there's gambling that we all know, but there's something that sits in the middle. And I looked up some of the stats for gambling, and it's quite interesting about, on one hand, there's so much political and regulatory oversight to protect people, in their investments. And you've seen even, some funds and so on get in trouble in Australia, and it's all quite, everybody's right onto it. But over on the other hand, we're letting people, and if you can believe this, since 2023, so just in the last 3 years, Australians have gambled $104 billion. Now, the losses are estimated at about it comes to about 666 million a week.
660
so it's about, on an annual rate last year, it was about $1,600 per adult.
Right.
And the other interesting little factoid is Australia's only 0.5% of the world's population, but nearly 20% of the poker machines.
Yeah.
So, and we're not here, there's no ethical, moral or any judgments on it, because you know what? It's a great, a pastime for many people. And we're not saying it's wrong or anything, but it's putting it in the right risk bucket. And this is where in America they're having a huge debate. The second point I wanted to make, they're having this huge debate at the moment about these new markets that have opened up. One's called Kalshi and one's called Poly markets over in the US. Now, these are kind of like betting markets, if you like. They're calling it kind of like risk swap markets or hedging markets, but you can really go and bet on almost anything. They were betting on the Iran war. They're betting on things like, all sorts of political outcomes, governor races and so on. But I was even reading there's little markets like how the price of eggs and where things will, you can bet on changes in oil prices and so on. So what we're getting at the moment is this in society, and because everything's an app now, people, and the main point we want to make here is people out there have got, a huge range of choices now about investing. So there's apps to invest, but there's also apps to gamble, and that they are two different things. So we just wanted to highlight there that the gambling and the risk you take in that area is not investing. It's definitely a personal activity, but it's.
And are you talking more about gambling at the pokies or gambling as in trying to trade the market? Yeah,
well, we talked about investing and risk in there.
Yeah.
And then I suppose we can talk about gambling being, very risky, but kind of fun. We all know that we have hopefully a little gambling or punting account, and that's fine. It should be a discrete amount of money. But we all know people that have got into trouble over that, and that's a risk that there's helplines and so on available for people that, obviously can help there. But I think I just wanted to touch on it, and it would be, probably 50 podcasts by itself. But I just want to touch in the middle where we've got this grey area at the moment where, and I would put like crypto investments in there. Now, is that gambling or is it investment? And people, I don't want to, again, ruffle any feathers, but investing in commodities like gold or silver, there's elements of both, and it's very, very tricky. But I'd say for the majority of people listening to a podcast like this, just be aware that risk is not a thing, it's a spectrum. So there's many things that sit very clearly like that you can have in your super fund. And Aussie super funds are very clear about what you can and can't buy in there.
Yeah.
And then we've, probably, betting that we all know over here.
Yep.
And that's risky, but it's not investing. But we've got this grey area in here. And that's the area I think people need to be very careful of. And our own business, we've seen people lose money to scams and so on in there as well. So it's just the area I advise great caution on is this grey area in the middle. That's all we're trying to say here.
Yeah, and I think the antidote to the grey area is your own education and awareness about what exists in that area. So like I started to say before, when you asked me to sort of categorize financial products into risk buckets, if you like, and we opened the book, and against low, medium and high risk are certain well-known investment products or vehicles, so things like cash and bonds, shares, property, and then alternatives, crypto, whatever you would like to sort of define as high risk. And that's a very well-known sort of product universe, if you like. And then we have a whole range of new products and investment vehicles, call them what you will. And what you'll find with people who invest in those products are two distinct sort of categories of people. And those are people who are, for lack of a better word, gambling or speculating on their, return in that investment. And the others would be people who hold those assets with conviction. Because they have a investment thesis that they have built, nurtured, acquired, developed through education, and often an extensive amount of education. Not here to say rightly or wrongly or agree or disagree with the thesis. That's kind of irrelevant. It's more that they have done the research and they hold those investments with conviction, typically based on a sort of level of understanding or their own understanding about what's happening in the world, what their own macroeconomic view is, an awareness of the risks of holding that investment, and in most cases a plan for what happens when the downside shows up at your front door. So I think the grey area, if you like, is really the antidote to dabbling or playing in the grey area is simply that it's, if you're going to not invest the time and purely speculate, then you have to do so knowing that what the risk is, what the downside looks like, and having a plan for that, and having a plan 2 or 3 levels deep. And what I mean by that is, here are all the things that could go wrong with this, including one scenario where I lose the entire investment. It goes to zero. What do I do if it drops a third, drops 2/3 and goes to zero? What's my plan? Does it involve selling? Does it involve holding and buying more? If so, why? And then if I lost the whole thing, what would that do to my own financial situation? And that's really assessing the risk. The other thing is then, if you want to mitigate the risk slightly more and potentially, if the decision when these downside scenarios happen is to buy more, well, you're only ever going to get to that decision by having some sort of educated understanding or some conviction on why you would do that. You're not just going to buy more of something that's falling in value by 25%.
I
unless
think you've very accurately summarised. Sorry.
I think you're never going to get to the position where you are acquiring assets on sale, as they say. It doesn't matter if it's Bitcoin or BHP, unless you understand or believe there's a really good reason to do that.
Yeah. Yep. Well, I think, as I was going to say, I think you've summarised how hedge fund traders and investment bank traders that I've seen and worked with.
Yeah, and that's
how they
that.
approach risk.
Like that's, you've got bond repricing. Like why would anyone,
right?
You've got to take on risk sometimes in your profession.
And talk about like gambling, like clearly what I was talking about before, Aussies love a punt. There's nothing wrong with that. But in markets, we try to systemize that in trading and have traders go, look, here's how much risk you can take. For every basis point movement in interest rates, you can take this much risk.
Yeah.
But if it goes down by X percent, you have to close that position out. If it goes up by – so it's exactly what you were just saying.
Well, I just watched The Big Short again recently.
Oh, yeah.
And there's that scene where Brad Pitt's sitting in the pub in England somewhere, in the middle of nowhere, and there's all these people staring at him because he's speaking a different language, basically trying to offload all these credit default swaps. So, and that's what he's doing. Like he's shifting risk from his clients and moving it somewhere else.
Yeah.
But, how do people at that level make decisions about risk?
Right. Well, and credit default swaps is, again, would be another great episode in itself. They're very benign things. They're just an instrument that reflects an underlying thing, which is why we call it a derivative. It's derived from something else. But banks can use them. They're like very levered ways of saying you want to get some more exposure to Ford Motor Company or, Apple. So a bank will write you a credit derivative on that. You don't have to, there's nothing underlying it. It's just, traded off a credit spread.
Yeah.
And they all look good because banks go, oh, well, let's say they lent $1 billion to Apple. Yeah. You can go and buy protection. It's like insurance, which is a great segue for our next section. But in effect, a credit default swap's buying insurance on it. So you can say, I want to buy protection on Apple for $1 billion, and it can offset your loan. So it's very good for the bank's capital. But then you also have your traders downstairs going, I think Apple's going to have a great result. The next quarter. So I'm going to start increasing my exposure to Apple, in a credit sense, because I think I'll make money doing that. So what you do is sell protection on Apple, so it's very interesting. And then suddenly in the GFC, when the world added up all the credit default swaps out there, it came to, I think, something like 10 times the whole world GDP or something. So
a little problematic.
We had a little, that probably was part of the reason we had a problem. So look, that is a great way to get us on to our next section, which is how to hedge risk for people. The two classic ways are diversification, and I'm sure you as an ex-financial advisor could talk at length about that, and also insurance.
Yeah. So, and just before we do that, because you've raised a good point, and just with movies like that, with The Big Short, and then I think with social media as well, people are exposed to the outliers that make good on large bets on certain things and do really well financially out of them, right? And those things are highlighted and pumped around the globe through movies and social media, friendship stories, Reddit blogs, like the GameStop, share the whole
meme
situation that, and so people see this, and there's truth to a lot of it. A lot of people do make a lot of money on very outlier circumstances that are what we would consider to be very unique, very opportunistic from a timing point of view, and where arguably a lot of things have converged in some ways largely outside of their control, like a windfall moment in that sense. And then there's mainstream herd-based wealth building activities like buying a property here in this country anyway, up until recently, and investing in the share market for the long term. that also works
Mm-hmm.
or has worked and arguably still does work.
Yeah.
So I think it's hard for people to reconcile risk and what they should do when they see this over here, which is, taking huge amounts of risk and there's big wins there. Like, how many times can I repeat that cycle over and over before I turn up, gold? Versus this seems slow and steady, but if my risk profile's a little, aggressive, like, am I wasting my time here? Or, I think the answer lies in being, building a foundation that looks or moves with the herd mentality, if you like.
Yep.
And then there is an element of like being a contrarian as well. That is something that should be overlaid.
This has been discussed for centuries.
Right? But I think the
it's
risk
fascinating.
profile is balanced, not equally balanced, but you're somewhere, you sit on the risk curve somewhere as an individual then.
Right.
And maybe you start down here and as your knowledge grows, you move slightly up the risk curve. Maybe as you start to not need to build your capital as much, or you just want to take less risk in your life so you can sleep better at night, you slightly move down the risk curve again. So it's a flexible, it's a lens that you look through flexibly.
Yeah.
Driven by personality, mindset, circumstances, yours and global, and goals, I guess, as well.
There's a lovely yet another market saying that markets can stay irrational longer than you can stay liquid.
Yeah.
So what that means is I recall firsthand the number of hedge funds that blew up shorting the US housing market, right? Lots and lots and lots of hedge funds. And the one that made in the movie was the one that made the fortune out of it. The interesting anecdote is if you read up on it, pretty much all his investors left the fund. There were no high fives when he made all that money. They were furious at the amount of risk. He risked so much
Billions.
of that fund.
Yeah.
Right? And that's not why they weren't in that fund.
Yeah.
They weren't sleeping well at night. And even when it paid off, they felt the money that he'd earned in that payoff didn't justify the risk he took.
Yeah.
And I remember hedge funds like Sailfish and all of these, everyone was on it. And guess what happened? The housing market kept going.
I know. Yeah.
So it's a great point. And it's the problem you probably have as a politician in many countries where you're grappling with this thing called survivor bias.
Yeah.
So everyone goes, oh, the venture capital industry must be going well, or this particular industry must be going well. Look at all the companies prospering in here. But the handful of companies that make it, that prosper and that eventually go public or make these huge IPO splashes are standing on this pyramid of probably the graves of 98% of companies that don't make it.
Yeah.
So setting policy to go, oh, everybody that starts a business must be doing great and they're going to be highly successful and so on is not recognizing that it's a very long, torturous path to get there.
Full of risk.
Full of risk. And you're right, you need to have a plan for that, but also just be aware that, yet again, another old saying that a trader told me one time when I was a bit skeptical of Bitcoin back in the day, and I was a bit skeptical about a lot of the trades that were going on in the market after the GFC. It was a very confused time. Was it the end of Western civilization or, governments were pumping lots of money in? Was it a great buying opportunity? It was very, very cloudy. And one of our senior traders looked at me and I was critiquing a company that he was buying a lot of bonds in. Mm-hmm. And I said, why are you doing it? He goes, because everyone's buying the bonds in this company. The price is going to go up. And I'm like, but it's not a great company. And he just looked at me and he said, Anthony, you can be rich or you can be right.
Yeah.
And he goes, you can't be both.
Yeah.
So it's what you were saying before. It's called momentum investing.
Yeah.
The herd's going to go.
You can't beat the herd often.
Yeah, remember Warren
At the
Buffett.
time anyway.
The stock market's a weighing machine of sentiment.
Yeah.
It doesn't mean it's right.
No. Yeah.
And the lovely, coming back to our friend Isaac Newton at the beginning, do you know what he said when apparently he wrote a letter to a friend, utterly baffled how he'd lost all his money? He wasn't broke, but he wasn't happy with his behaviour.
He was wounded.
And he wrote to his friend and he said, I've investigated and written about the movement of the heavens. the stars in the heavens and the planets, but he goes, I can't write and understand about the behaviour of people. So
Yeah, it is
there you have it.
fascinating. Yeah. So you wanted to talk about insurance or whatnot.
Talk to us about how to hedge risk, the easy ways of diversifying, which is why when you go to your friendly super fund, they'll be like, I'm not selling you a BHP share. I will sell you, we run a balanced fund.
Yeah.
And so what it is if you've got 100 things sitting in this, it's like a bucket. So what you do is instead of having one share, nobody goes out and puts all their super into Telstra. Maybe somebody has. It'd be great to get them on the podcast. Be a little bit irrational, but might have worked for a while. So what do? You just put lots of names in the bucket. And then if one goes bad, your bucket's kind of okay.
Right. But you can also over-diversify.
That's diversification kind of in a nutshell.
So, yeah, I think – and look, in the interest of time, it's because the ways that you mitigate risk are varied and many depending on what risk you're trying to mitigate. Sometimes you do it through products. Sometimes you do it through planning, strategy. So it's not always about finding the product or the thing that you can buy to mitigate or reduce a risk. But yes, you're right in the case of investing, whether inside or outside of super, it's usually done through the process of diversification. So that means going back to that risk curve and understanding things that are low, medium, high risk, just spreading the risk in a way that fits the circumstances or your circumstances. So if we do hit a roadblock or something that triggers a downside risk to come to fruition on something that's higher risk, then you've got the rest of your portfolio sort of trotting along as expected to offset that downside. When in insurance, life insurance, for example, which is something I'm quite familiar with, the way that we offset risk is by taking out an insurance policy. Now, that insurance policy is for an amount of money. It might be an income stream or a lump sum. And if something happens, we call it an insured event. It could be a health event. It could be, it's largely a health event. It's just depends on the severity of the health event. It could be just something that means you can't work anymore, in which case we have something called income protection. It might be something more serious, like a critical illness, something like cancer or a stroke. For that, we have something called trauma. And then we have total and permanent disability and life death cover, which is for, as those terms say, disability and death. So how someone works out what level of cover they need, again, comes back to your own circumstances. What are you trying to ensure? So if something terrible happens, what happens in your life? Something stops being funded, something you're going to go without. You might have to sell an asset. How's that going to affect you? The point of insurance is just to ensure your life and your circumstances can continue as though the thing had never happened. So it's the degree to which you want to be able to continue on as though nothing had happened. That's the level to which you would insure yourself. If you're happy with a little bit of an interruption financially, maybe you take that amount of insurance. If you want no interruption, then you need to be looking at what that actually means. And it really comes down to again what you are willing to ultimately self-insure. So that means I'm happy to just accept that something might happen to me from a health point of view, but if it does, I'm going to use my assets and my savings and the goodwill of my family to help me through and manage that. Now, that's great and sometimes that works. It's just that if that period is 6 months or 12 months, that was probably fine. Yeah. If it's 10, 15 years or the rest of your life, then that's when that becomes, that plan on its own becomes a problem. Yeah. So it's really just starting to think about what could go wrong, how likely is that, what would it cost me, am I happy with that, what would happen, would I have to sell assets, my kids not go to the school I want them to, we'd all, I'd have no more super being contributed because I'm not working anymore. How much of that scenario playing out can I live with comfortably?
Well, this is what our coaches talk about with some people too. It's an issue that's becoming more and more prevalent, and I think it's going to get worse in the next year, which is cost of living affecting people. And there are more and more reports we're reading about out there that more and more Aussies can't afford to insure their house. It's fine if you own your house outright, because you may sit up late at night going, well, what are the odds of my house burning down? Pretty low. So I can kind of self-insure there. But there are real practical things coming up for people. And this gets back to our earlier discussion about there are things that you can kind of think about and turn the dial yourself on. But there are other factors coming in, which is just the sheer cost of insuring a house now is very, very high for a lot of people.
Yeah.
But if you've got a mortgage on your house, you
have to have insurance.
Required. But a lot of people are going, well, I might just, for the next year, I might not pay that. I'll suspend it. But again, coming back to our topic, that's a risk.
Yeah.
It's a pretty big risk. But
at
the end of the day, you have to kind of make it to the next day, don't you?
Well, that's right.
Yep.
We're all risk managers.
Yes.
Like every single one of us is a risk manager.
Mm-hmm.
It's just we're doing that job in our own lives to a different degree.
Yep.
Depending on how much we want to look at it.
Right.
So I think I don't think it's natural for us all as individuals to sit around and constantly be pulling out, our risk assessment on our lives. And
we'd all live in a hole in the backyard and probably still worry about
where do I sit on the risk curve about the house burning down?
You wouldn't drive your car. You wouldn't get on a plane. You wouldn't.
Yeah. Where do I sit on the risk curve about my wife having a car accident?
All right.
All of those things, nobody's doing that. So nobody sitting here at this table is being unreasonable here. It's more just that is actually the situation that is playing out. It's just we're only 5% on top of the risks that we're subjecting ourselves to at any one time. But you're right, in a perfect world, we would be covering every single risk. We would have a plan for 100% of them, and we would have an action plan for the downside risk of all the risk that we're currently absorbing. Yeah. But we don't. So I think you can pull back from that expectation and say, at the same time, we don't have to have the minutiae, like the detail defined, line by line, how are we protecting ourselves? Realistically, we cover ourselves with insurance for the key, most critical things that starting with what we have to self-fund. Like if you've got a mortgage, you need to have property insurance. Yeah. So tick off all the things that you have to insure and leave, then we go down to, okay, well, what are the things I voluntarily want to opt into and to insure? Because to me and my family and my life at the moment, those would be massively problematic if I let them go uninsured and something did happen. And the risk of something happening is high. And then there's this other bunch of things that exist in our world that, there's a risk attached to them. But right now, we're happy to self-insure for that risk because maybe it's a low to medium risk and the cost of insuring it is high or not available. And so that's what savings, mortgage redraw, liquid investments, that's what that's designed to cover. It's to help us cover the things we are ultimately self-insuring against. Yes. That have that risk attached to them.
Don't you think the annoying thing is just paying for so long and generally we all sleep at night having, whatever you've chosen to do, health insurance or fire protection or whatever. Yeah. But now that I'm kind of well past the I've got less of my career ahead of me.
You're really pissed off.
Yeah. Like how I've been paying health insurance from the year dot, and my house I've insured it for 35 years. I've had a house, and it hasn't burnt down. Oh, so part of me is like, you should kind of burn something down and get my money back somehow or other. But we paid all this money. You'd argue for nothing.
Yeah, well,
but it
depends.
It's the frustrating thing about insurance.
That's right, and I know a lot of people think like that about insurance, but it's more looking at it's not just it's been for nothing. it's given you a lot of other benefits, undoubtedly. Maybe there was a legal obligation for you to insure your house for a period of time anyway. So just for that period, you couldn't have done anything different.
True.
So don't beat yourself up about it.
Yeah.
But for the period where you voluntarily insured something, sure, you could say, oh, well, I've added it up this times 12 per month times however many years, and I've spent, I don't know, like 20 grand on health insurance, property insurance. What could I have spent 20 grand on?
Yeah.
Well, yes, but also if your house had burnt down and you hadn't had that, what would that have cost you? What would have been the impact
Well, what
on
would
your
it cost
life?
now? Can you imagine?
We're talking about millions of dollars,
Yes.
most of it, or at least $1 million in
And
most
so
cases.
the other problem probably is a vast number of people are underinsured. They've probably insured their house for X, and actually to rebuild that house is probably 1.5 to 2X.
True, and that's about the fine tuning of risk, right? But I think at least they're mitigating the risk by having
true.
some insurance, and then they're self-insuring that balance. But if you're ever in a position where you're at a loose end and you just want to like fine tune your risk, go through all your insurance policies and work out where you're underinsured. But again, no one's going to do that.
Well, and this is where we come to our final little piece, which is the framing, the academic framing of a lot of this. And there were two chaps back in the day, Daniel Kahneman and Amos Tversky, and they won a Nobel Prize. I don't think Amos got it because you can't get a Nobel Prize if you've passed away, apparently. They're not posthumous. So you've got to show up in Sweden. So if it gets announced, you've got to do everything you can to stay alive. Otherwise, no prize for you. You've got to go up and actually claim
Worked
it.
your whole life for that and you miss out right at the end.
I know. Well, you don't get paid out if you're the one that died, right? So that's also a downside of life insurance. Can't take it with you, Rebecca.
Yeah, but your family's well protected.
That's
so,
true.
You know,
So they won a Nobel Prize. And the other little funny thing was apparently on the review panel when they were presenting the paper on, it's called prospect theory. So you can go and read about what they won this prize for. Milton Friedman, can you imagine going, like, I know it's a nerdy reference, but Milton Friedman, one of the fathers of economics, was on the panel critiquing the PhD that Kahneman originally did. And he said, this is a great paper, but it's not economics. And it was all about, and you could argue, it's probably a very academic argument, but is it philosophy? Is it psychology? Is it sociology? This is the thing, and he identified a couple of things, and we won't go into all the details. Definitely, if you're interested, you can Google prospect theory, but one of them was loss aversion, as we've talked about endlessly. And he found, but he was the first one to systematize it via experiments. And people, once they had a gain, so if you have $100 and it went to $200, people would do whatever they could to lock it in.
Yeah. Crystallize it.
But if they were down $50, they're like, let it ride, let's keep going. And the losses were, so it's exactly the opposite. So if somebody's, maybe trading or somebody's looking at their super and they're like, wow, that's a pleasant surprise. My super's done quite well. Oh, there's an instinctive reaction to go, let's start taking money off the table and locking in.
Yeah.
No, it's not. Don't listen to your instincts. Do some research. But again, as we said, time out of market you can't get back.
Yeah.
The thing that's in your favor is time. Volatility is going to happen, but volatility can be in your favor. So they came up with a figure of 2.3, like a dollar lost feels 2.3 times worse than a dollar gained.
Yeah.
So you go from $1,000 to $900, but $1,000 to $1,100, everyone's like, eh.
You know what?
It's so fascinating.
You know what? If you just want a real time, like super relatable way of looking at what risk assessment or risk profile means. Have you ever seen that show Deal or No Deal? You probably don't watch it.
I've seen it. I can't say I've been an avid watcher. But
My kids like it. So they like to watch
it. Is that the
it
suitcases?
while I'm cooking dinner. Yeah. So they watch Deal or No Deal, and I often just am walking in and around and I'll see it when they get to the final, they get their opening suitcases, knocking numbers out, and the bank's giving them a deal.
The bank rings or something and gives you...
Yeah, the bank's giving you a deal, right? And it's
but the bank knows which one the case is in. That's why it's skewed,
right?
isn't it?
So the top amount you can win is 100 grand, and it's at 50 cents is the bottom amount you can walk away with.
Okay.
So that's just the perfect microcosm of what a risk profile looks like amongst a group of people, of individuals, totally unrelated. unconnected, just people coming into a room, situation being put in front of them, and then they've got to make a decision about whether to take the deal. Now, it's fascinating because, you get like some people $5,000 and they're like, I'm taking the deal. And the whole crowd gets to is asked whether they should take the deal or not. And you've got half of them doing this, which means take the deal, and half of them doing this, which means don't take the deal.
Okay.
And as the different amounts, they knock numbers out and different amounts are offered to this person
See,
playing the game.
this brings in the herd mentality we were talking about before.
You see the audience's risk profile showing up.
But the audience has no idea either, do they?
No, they have no idea, but it's more like...
but some people take the $5,000, don't worry about the $100,000.
It's more what people...
And there's probably somebody worth $75 million in there going, just go for it.
That's right. Well,
I don't care. Who
there's all their
cares?
own personal circumstances.
Right.
It's what's a lot of money. It's how much would it take me to earn that kind and save that kind of money. What's the risk as we open more and more cases of the deal going up or down?
It's very tense.
And people are just there as an audience. I'm just fascinated by the number of no deals versus deals as we open a different case every time, because it's just like in real time, people are making judgments about the risk of opening one more case and getting knocked out of the game and walking away with 50 cents versus whatever's in front of them.
No, it's a good game.
So I just think we're all different and we all have our own way of looking at and assessing risk. Some people are still at becoming aware of the risks around them. Some people are at the other end obsessed with risks and can't move forward on anything because of that.
Yep.
So we all need to find our perfect sort of operating system for risk assessment and making decisions through life, about money, about relationships in a way that is considered about the risks but not overwhelmed or prevented from making decisions about risks. So hopefully what we've chatted about gives a little bit of a framework for how to deal with that.
Yeah. Yep. I think that's a great place to stop. Take some risk, understand your risk.
Yeah.
Don't think that if you don't take any risk, you're not taking risk.
Yeah.
Because you're taking risk.
Yeah.
And
Work
don't
that
be
out.
like Sir Isaac Newton, have a plan, stick to it, and hedge.
Yeah.
Have a little punting account. Everyone likes a gamble. Our earlier comments about that, no problem. But just make sure it sits in your overall risk framework.
That's it, people.
Great stuff. See you on the next episode.
See you next time.
If you enjoyed this episode as much as we did making it, definitely follow along. And I'd love to see some questions. As you can tell, there's no shortage of us giving very long-winded answers to whatever intrigue and drama that you have going on in your life. So drop it in the chat. We'll engage and we'll make everybody happier and wealthier.
My Money Circle is a corporate authorised representative of Novus Capital Limited. The information provided on this podcast is general in nature and does not constitute financial product advice. For personal financial product advice, please consult a licensed financial advisor.